Okay, now we're going to have a panel discussion for you on filling the funding gap. This is obviously a vital part of the scale-up process. You've got to get someone to pay for it. So to take you through this panel, I'm delighted to welcome Samuele Ambrosetti. He's Head of Programme and Innovation at the Bio-Based Industries Consortium. And if the other panellists would like to come and join us on the stage as well, Samuele will take you through the panel. So, Samuele, over to you.
All right, thanks a lot to all of you, of course. Good morning to all of you. Thanks for being here. Yes, I'm Samuele from the Bio-Based Industries Consortium. We are the leading organization in Europe for bio-based industries, over 400 industry members, over 300 members from the research and innovation community across all the different value chains of the bioeconomy, from the very large multinational corporations all the way down to the very small startups. So we're a very inclusive community. I'd like to point out also we have around 30 clusters and territorial organizations because, of course, local bioresources, local biomass are the cornerstone of bio-based value chains. We already have our 4 panelists here, and I will introduce them in 1 second. Before that, I would like to point out, as an organization, our actions are organized along 3 main axes. One is innovation and scale-up, where we try to create opportunities for members to cooperate in joint R&D and I projects. We have policy and advocacy, where we engage with especially European policymakers to make sure that the legislative framework is favorable for bio-based value chains. And then we have access to finance, which is the subject of today's session. By the way, an important element of our identity since the beginning in 2014 is that we are the representative of the private sector in a public-private partnership, where the public sector is the European Commission. It's called CBE, Circular Bio-Based Europe Joint Undertaking. I guess most of you are familiar with the partnership. If you're not, please do check it out, because there are quite interesting calls for proposals out right now. There's 170 million euros available for projects from TRL 5 all the way to TRL 8. And of course, a European grant or a national grant or subsidy can be a great booster, especially when you are in the development stage of your technology or your process. But then when you actually want to scale it up to industrial scale, you need to bring in capital. You need to bring in additional investment. And that's why we're here today with our 4 panelists. So we have it in the title, filling the funding gap. There is a funding gap. This is something that we all agree about. And what we will discuss today is the reasons for it and hopefully how we can work together to close it. So without further ado, I'd like to introduce Marco Jansen, Chief Commercial Officer at Avantium, Ward Hay, Business Development Manager at Kolesco Capital, Greta Zajončaskaitė, Head of the Life Sciences team at Invest Lithuania, and Rolf Kjærgaard, Special Advisor of the Novo Nordisk Foundation. Please give him a round of applause. Thanks a lot for being here with us today and accepting to be on this panel. So I would maybe start with Marco from the company perspective. So as a scale-up company, you have now built your first-of-a-kind plant, so you can maybe share with the audience a bit of lessons that you learned throughout the process of scaling up. What worked well with you from the financing point of view? What maybe in hindsight you would do different? What have you learned from this process?
First of all, good morning, everybody. Thank you. And I must use a disclaimer because my part of the journey has only been 2 years out of a journey of 26. But I've learned a lot in the last 2 years. And I think, as we saw in the previous presentations from IFF and Chaincraft, it all starts with an idea. And it starts with an idea that, in our case, is more than 20 years ago. And from that idea in a lab, you get to, in our case, a first-of-a-kind plant that was finished and is being commissioned and started up as we speak. And you can see the funding needs grow over time. And initially, there's a lot of funding available. When you're a very early TRL, it's quite easy to get funding. First of all, the cost is low, or relatively low, let's say, and it goes up over time. But also, the instruments become less and less. And I think this is probably one of the reasons why Avantium decided in 2017 to become a listed company. And that brought a lot of advantages, but also challenges. And I think what Avantium's been doing well over the past years is combining many different funding instruments, from debt to subsidies and different kinds of equity. Equity through different fundraising activities, but also we're in the fortunate position to have the support from the Dutch government, who's a major shareholder now in the company, who truly believes in the company and the technology that we provide. And I think we have the luck of having really loyal shareholders. So almost every funding round that we had, over 90% of the existing shareholders joined that funding round. So there's a lot of, let's say, loyalty and confidence from existing shareholders in the future of the company, which is really amazing. And I think with our compelling story of the product, which is I don't want to have a sales pitch here, but it was considered to be an alternative, bio-based alternative to PET. But then very early during that process, we found out that the product, which is called PF, which sounds very similar to PET and looks very similar to PET, but it has significant barrier improvements for CO2 and oxygen. And then we found out that it's not only more sustainable because it's fully bio-based, but also it's a truly, let's say, high-performance material. And with the licensing strategy that we have as a company, so we try to stay relatively asset light, although we invested 200 million in this first-of-a-kind plant. We've been able to continue to get the commitment from existing and also future new, let's say, equity partners and shareholders. So I think that all goes really well. I think where we struggle maybe is, if you're a deep tech company like we are, you have this very long process, as IFS showed also, and we're not a company like IFF or DuPont, who have a good balance sheet to support these kind of initiatives. You need continuous funding through that process, and it goes up, and you depend on subsidies and governmental support during part of that process. But if you're in a pre-money phase as well, pre-revenue phase as we are, after a certain time you are classified as a undertaking in financial difficulty, and then what happens is you don't have access anymore to public funding, and that's a real challenge for a company like us and other companies that have this really long development phase, and there's no differentiation between types of companies. So that's where we struggle. And also what you see is that the focus on ESG goals for investors is going down. In the previous years, this was one of the top priorities, but you can see that going down. And we're seen as a high-risk investment because we're still, let's say, in TRL 8. We're very close to commercialization, but still, it's a company that's not profitable yet. So I think that there we struggle, but I think any company would struggle, to be honest. I think we've been quite fortunate to get the support that we had so far, and I think we've been very successful in fundraising. But it becomes more and more challenging over time.
Yeah, thank you, Marco. I would then now turn to Ward. So let's move more to the investor side or lend side. As an impact private debt operator, you have a role which is a bit in between a bank and a venture capital. So also based on what Marco just said, what do you see as the most common barriers that you encounter when engaging with bio-based startups, or the other way around, what are the critical success factors for you to engage with a bio-based startup or scale-up?
Yeah, that's a very good question. And first of all, indeed, good morning all. First, for context, so we are an impact private debt fund, and we provide loans before a bank could typically do so in bio-based and circular economy. And that means that we can take commercial risk and technological risk while scaling up an innovative technology. There are many things that we look at, but I'll simplify it into two. And I think the first, Mark from Chaincraft was already talking about that is building a credible business case. And that is super duper difficult, in all honesty, because bio-based alternatives need to basically, compete with fossil alternatives that have been around for decades. And if we look at that business case, it can go two ways. First, there needs to be price parity if there is not a binding law that mandates higher prices. And if that law is not there, then we need price parity. In some aspects there are laws. So if you look at RED, for instance, that mandates biofuels, then we see off-takers willing to purchase for a higher price, and then investors are also able to accept premiums. But I think, Marco, as you were alluding to, that ESG awareness in investors is getting lower and lower and lower. We also see lower acceptance of price premiums in equity investors, particularly. And that's really a big problem, because we have a large pipeline of first-of-a-kind projects in the Netherlands and surrounding countries, and many of these projects are currently delaying because it's very hard to find project equity at this time, very specifically because the business case often just doesn't hold up. And next to the business case, there is a second portion which we look at, which doesn't sound very sexy, but is very important, is risk allocation. I think as a business matures, the attention shifts from upside optimization to protecting from downsides and from risks. And as you build a first-of-a-kind plant, or maybe a next-of-a-kind, and you scale up, it's really about managing those risks across the entire value chain and making also sure that you build the partnerships to share those risks. So if we look at a plant, we're looking, has the feedstock been contracted? In construction and operation and maintenance, are there partners engaged that share all of those risks? And on the offtake side, are there offtakers willing to commit to certain offtakes for certain lengths and certain prices? Those are hugely important, and if you do that, and if you build a solid business case, then also you protect yourself from surrounding factors like uncertain policy and uncertain market dynamics. And if those items are in place, business cases become more bankable and more reachable.
Thank you. I would then maybe move to Greta, another kind of investor, more related to the institutional side of investment. So it's interesting to me also to build on what Marco said about the Dutch government support that they received. So what is your experience, Greta? What kind of tools do these kind of more institutional investors provide for bio-based startups and scale-ups in the bioeconomy space? How do you see this experience?
So most of our experience has been in the previous years with the mature companies, and I think the challenge has been identified that most of the tools we have is challenged by the fact that we cannot give governmental support for the companies that are undertaking the difficulty. So I think in the last few years we try and we opened our vision to another partners in the ecosystem that we have, such like developmental banks, private equities, trying to form coalition, kind of similar view. How do we come into a partnership there? Because we cannot be one kind of thing, governmental support, because it's still taxpayer money that we are contributing to the companies. But it's definitely a tool that we can open the doors to such parties as a national development banks, and then once one party is there, I think it's easier for the government as well to join and say, okay, we do have money and we do want these scale-ups to come forward. But it's definitely a process and a part of engineering. How do you do that? And I think we are trying to kind of catch up with the private equities, but it's a very important thing to understand that we need to have exactly the same eligibility criteria as the bank has, as the private equity has, because the scale-ups don't have enough resources to comply to all of them. So this is one part. So definitely the subsidies are there. We have cashbacks, we have tax breaks, and we are more than ready to give them, but it has to be credibility. But what we can do from another side before we come to that, and Invest Lithuania is a consulting agency that helps also to optimize the business case. So I think this is also where we try to step in, and what also has been mentioned now, that it has to be thought about raw materials, location, even the land plot costs and all the other things. And we try to step in there as well, because we can give funding, but I think the other part is also to have a valid business case. And it's a lot of things are happening in Netherlands, but there's a lot of European countries that has quite interesting locations with the different pros and different cons as well. But it's interesting to look at that and try to position scale-ups in towards these countries that has a lot of raw materials, that the price is lower, and that already gives a lot of benefit. So we work in this type of mixed support for the companies, so it's not only cash that we can give, but it's also support in a consulting way to help for the companies to be more credible to the other partners that are here.
I think you touched upon a quite important point, the involvement of the development banks, but also the, let's say, creation of network and creation of awareness across Europe. By the way, there's a deployment group on investment in Biobase that is meeting this afternoon. So that will be a nice forum, I guess, to start this kind of discussion. But also the fact that perhaps bio-based startups and scale-ups are a bit different than others. They require a bit longer time for payback. They may have a different risk profile. So turning to Rolf, maybe also the KPIs that we are used to when evaluating a company, maybe we have to rethink them a little bit. So as the Novo Group, you combine both the, let's say, investor approach of a large corporate and the philanthropic approach of a foundation. So maybe you can be a good interlocutor for this kind of discussion, how to balance the return of investment logic and the wider societal impact logic.
Thank you. Thank you to everyone for being here. Thank you to the organizers for pulling together such an amazing crowd and for organizing this conference. And thank you for this opportunity to be part of this excellent panel. For context, the Novo Nordisk Foundation is actually the holding entity of a whole range of assets. And one of the core assets within that is the controlling shareholdings behind the Novo Nordisk and the Novo Nordisk companies. So the Novo Nordisk Foundation is an enterprise foundation, which means that, and it's actually the largest of its kind in the world. But getting back to the question around how to combine long-term capital deployment with variations across the returns profiles that you're seeking as an investor. Within the Novo Group, what we're really looking to do consistently is to take a holistic approach to everything that's being done across a platform, across instruments, and across the different departments and entities throughout. And really taking advantage of the span of agency you have when you have an enterprise foundation, which consists of a philanthropic muscle, where we can do grant giving and support research and innovation without money flowing back, but really driving societal benefit. And then the investment activities, which sit for organizational purposes within a separate entity called Novo Holdings, which is the investment arm, 100% owned by the foundation. So it's really a neatly designed structure internally that ranges all the way from early basic science through support of universities and research institutions, through the different stages in the value chain and across the broader ecosystem. So when we talk about, as in the title of this debate, filling the funding gap, I think when we speak with entrepreneurs who've gone through that whole journey, as have yourselves and others, it's not about just one gap, and once you get past that, then you're in good shape. No, really, there's a whole series of chasms you need to cross, or obstacles that you need to address and move around. So it really boils down to being, hopefully, what you're striving to do is go through a continuous process. But as investors, and certainly as foundation investors, what we're looking to enable is a much smoother journey through those different stages by deploying activities along those value chains across the bioeconomy. So specifically, or to mention just a few of the examples, aside from doing grant giving to research groups across multiple universities and research facilities, we We also set up the Bioinnovation Institute, which is a bioeconomy accelerator. So far, working very much from the Copenhagen domicile, but recently was given a pretty substantial allocation to drive an internationalization strategy. So we will be building satellites and partnerships across all of Europe to drive that that approach to leaping from science into pre-commercial activities, as is the core activity at the Bioinnovation Institute. Then on the investment side, we do direct investments into companies, and also as an effort to fertilize the co-investment or the co-investor ecosystem, we're also doing fund investments. So acting as a fund-to-fund investor to grow that out. And we've set up companies like 21st Bio, that's a precision fermentation industrial scale enabler. And connecting back to the key shareholdings of specifically the Novonesis company, we've also created, along with the Gates Foundation, a project partnership around turning CO2 into acetate, where hoping that it will be successful. The fact that it's already incorporated into the corporate structure of Novonesis means that there's a direct path to large-scale commercialization. So, as you can see, really wanting to be a systemic force in the broader ecosystem. In many respects, also somewhat successful at doing that, and there's a lot more work to be done, and we cannot do it alone. None of us can do it alone. So getting back to the coalition building, the coalitions of the willing, the need to have many more of those. Recently, we were actually the largest private investor into the Scale Up Europe Fund, which is another category-defining investor segment, and I specifically say segment because now we have one Scale Up Europe Fund. We need to multiply that many times over going forward, but the modality around pulling together different investors, including Santander, APG, the European Commission, the EIB, and what have you, there's a model to propagate from that. And finally, huge expectations for the investment deployment group, which we are also joining from the Novo Holdings side. So much to do, but lots of great people to do it with.
Thank you, Rolf, also for partially covering my final question. 1 minute to each of you, the same question to all of you. We've heard a bit of already input about trends that you see in bioeconomy investment. Is it getting easier? Is it getting harder? But more importantly, what can we do, what we should do, and who should take action to attract more investment in bioeconomy? 1 minute each. Let's start with Ward.
Thanks, and I'll need to apologize because I'm going to mention things that are beyond our direct control. I think it's 2 things. Tying it back to the business case, we need a level playing field for bio-based innovations. And for that level playing field, we need predictable, strong legislation that mandates a level playing field for bio-based innovations, first. And second, we need patient capital. And I think, as Rolf said, we don't need one fund, we need many, many funds. And we need many, many funds that deploy either private or public capital that matches the timelines and the sensitivities and the specificities of bio-based innovations and scaling them up, which takes much longer and costs much more than what a typical VC now is used to.
100% agree. Rolf?
Following pretty much in the same strain, and maybe hesitating somewhat to call it an outright trend, but I do sense a growing awareness around the need for not only compatibility, but really a strong linkage between all the stuff we're doing on the research funding side in the European context, it's the Horizon program. We're really channeling a lot of money into that. So are national governments and foundations all across Europe. But we need to combine that with the same level of dedication and determination when it comes to all the great results emerging from that science being funded, moving into the commercial space. So on the regulatory LCA side, that awareness that, like I said, I do sense is growing, that what we're looking to achieve on the funding side, on the research side, that needs to be emulated, that needs to be deeply embedded within how we approach and truly embrace all the new great biosolutions emerging that need to be put as quickly and as smoothly into the commercial space. And that really requires much more acceptable regulation. So I'm encouraged by the proliferation of sandboxes across. We need to have a lot more of that, but it's down to the mind frame.
And making sure that what is developed in Europe with European funding stays in Europe when it's time to scale up, like Avantium is doing.
Scale up.
Marco.
Yeah, I think 3 points. I'll try to do them quickly in the 1 minute, but I think startups, scale-ups, pre-revenue companies, they are disadvantaged for the ease of getting access to capital compared to profitable or companies with a good balance sheet. Also, the cost of capital is significantly higher because you're always seen as a high-risk investment. So you're disadvantaged in these two. And then finally, what I mentioned earlier, undertaking a difficulty definition for deep tech companies makes no sense. I mean, at the time when the money is really needed, when the investment is being done, you reach a point where you cannot get access to that funding anymore. And even because there's discussions now about adding 5 years maybe in a time frame, it doesn't make a big dent in that because, as I mentioned, it's 20-25 year investment, hundreds of millions, and then you get to a point when you commercialize, and they almost use all the funding that's gone into a technology even before it becomes commercial. So I think that definition should probably be exempted for companies that are really deep tech.
Patient capital, but also patient legislation. What do you think, Greta?
I think there's a lot of money out there. This is, I think, my first statement and a positive statement, that there is a lot of money. I think the question is how to get the money. I think what we need is not only one big grand system, not one perfect plan, but I think we need to do a lot of small different trials and to push these scale-ups through the pipeline and test on it, because I think every scale-up is very different. They have different ambitions, they have different appetite even for the speed they want to go. So I think what we need to do is, as a European Union, as national governments, as private parties, I think we need to be a bit faster and a little bit more flexible. So this is one part. And a second part is what I also talked before. I think we need to do a lot of our homework as a national countries. So we need to prepare the ground so the scale-ups doesn't need to figure out many other things apart from technology, that a lot of things are in place, you know, like starting from infrastructure, going to resilient supply chains. And this is all the questions that takes a lot of time for a startup to figure out, because it's not a company that's been in the industry for 20 years. So everything is new. So I think we need to do a lot of homework for that sphere as well. And then, you know, like getting a funding is easier when you know what you're doing already. So I think it's a lot of small iterations of this is something that I would do and I would go for.
A distributed model, but with a central sort of coordination. Well, I would keep this panel going for ages because we have so much to discuss, but unfortunately we have to close this session. So please, round of applause for our panelists. Thanks a lot for a very engaging discussion.